Greetings and welcome to another Meet Kevin Report. It's fantastic to have you back. It is a Meet Kevin Report 123 on July 24th. We just got data in on import prices within the last 10 seconds. Import and export prices, actually. And it is good news. Import prices, month over month, the survey said negative 0.1%. Actual, negative 0.2%. Import prices excluding petrol, month over month. Expectation said 0.2. We ended up getting 0.3 to the downside, both of them to the downside. We got a little bit, we just got a revision coming through the tape here. Looks like the prior import price index read was revised up slightly, though, from negative 0.6 to negative 0.4. So it looks like a little bit of a give back there with that prior revision. Import prices year over year at 6.1% to the downside. That's from 5.7 in the prior with a slight revision. And then we have export prices month over month. The expectation was a 0.1 to the downside, and we ended up getting 0.9 to the downside. So substantially a lower export prices than expected, with the year over year export price index coming in at about negative 12%. Absolutely remarkable. So large deflationary numbers here on import and export numbers just out within the last minute. Then obviously, if you haven't seen it yet, it is worth looking at what just happened with bank earnings. Let's quickly go through some of the summaries that we got from the JPM and Wells Fargo earnings. They can be a good tool for understanding what's going on in the economy. And I figure the best to do is get right into them. So JP Morgan provision for credit losses does come in a little higher than expected. We were looking for 2.9. We ended up getting, we were looking for 2.62. We ended up getting $2.9 billion. We've got a return on equity of 20% versus the expectation of 16.3%. So a lot more profit over at JP Morgan than expected. Net interest income coming in at 2188 versus expectations for 2117. We also have cash. Let's see here. Total deposits at 4.2 trillion. Estimate was 4.44, so a little less than expected. Loans coming in higher than expected at 1.3 trillion. The estimate was 1.24. We've got investment banking revenue coming in at 149 versus 138 expected. Net charge-offs coming in at 1.41 billion, roughly in line with the 1.4 expected. Trading revenue comes in a little soft at 2.45 billion versus the 2.51 expected for JP Morgan. They do indicate probable changes to come for banking liquidity, especially as the impacts of higher interest rates are still yet to really be felt. They also caution, as you would expect every bank to do, the impact of potential regulatory change on the banking system after the banking crisis at the beginning of the year. Let's see here. JP Morgan also took an after-tax gain of $1.8 billion on First Republic. That's at least what they're writing up on their income statement. We've got, let's see here, almost all lines of our business saw continued growth. Some commentary coming here, looking for a little bit more from JPM. And Jamie Dimon. Jamie Dimon says consumers are spending, quote, albeit a little more slowly. Now, I think that's also fascinating because this is important for analyzing, hey, what direction do we think we might actually end up going in terms of a recession? A lot of fear right now that we might be going straight into a recession. And a recession is generally driven by the consumer, with 70 to 72% of the economy driven by consumers. That fluctuates between 69 to 72%, depending on the year. And obviously, a slowdown in consumer spending could lead to a recession. Right now, Goldman Sachs has us at about a 15% chance of recession, with Bloomberg economists, an average of consensus of economists, having us around 65% in terms of a chance of recession. A lot of this obviously having to do with the inversion of the yield curve, and then, of course, some of the expectations that the tightening to come that is still to be felt from the Fed's tightening cycle is still very great. There are salient risks in the immediate view, says Jamie Dimon, even as the economy remains resilient. I think you have to also remember that to some extent, the banks want to signal like, hey, things are still fragile. Don't overregulate us now. Do that at some point in the future. Let us keep raking in the tendies in the meantime. Good for them. We've got a significant uncertainty in net interest income outlook, but they're still doing well. Early delinquency rate, quote, more or less at pre-COVID level. They are seeing a delinquency normalization, not a deterioration. And they don't particularly expect to tighten credit conditions any more than they already have, says the CFO over at JPM. And they do think they actually might see a little more growth in headcount this year, which is actually positive, again, towards an economic driver, that maybe 2022's layoffs were really just a rejiggering, sort of a reorganization of where people wanted to work. So let's look at Wells Fargo now. That was JPM, and let's do a quick review of Wells Fargo, see how they compare, and if there were any key takeaways here from good old Wells Fargo. All right, so here we go. Wells Fargo comes in with a revenue set of $20.53 billion, beats the $20.13 expected. Provision for credit losses a little higher than expected as well, $1.71 billion versus the $1.55. Total average of all deposits does come in as expected, $1.35 trillion. We've got net interest income of $13.16 billion versus $12.89. So the bank's doing very, very well. You've got plenty of income coming into the banks, and earnings per share of $1.25 over at Wells Fargo. Wells Fargo has not seen significant losses in the office portfolio yet. This is really despite a lot of fears of losses in office, although I wonder how many of these offices are really mark to market. A lot of office buildings really expected to suffer somewhere around a 30 to 40% markdown. Commercial banking at $3.37 billion versus estimates of $3.28. Provision for credit losses, 1.71. We talked about that. Wells Fargo did repurchase about 100 million shares, and both banks jumping here after their earnings and remarks. Some of the notes were that the CFO of Wells Fargo thinks we are, quote, still very early in the commercial real estate cycle. That could be why they're defending the idea of not yet taking any kind of mark-to-market losses. Real estate does tend to move significantly slowly. Commercial real estate outside office is performing quite well. It's true. We've seen that rebound since Jan 1. Consumer spend has, quote, consumer spend is largely driving the decline in deposits that they're seeing. So people are still running down their deposits, and what are they doing? Certainly not saving. That'd be crazy. They are spending. So that gives us a little bit of a look into Wells Fargo and JP Morgan. Both of these indicating a strong and continuing to be strong economy. This lines up with the import and export prices we just got that came in lower than expected. We will have inflation expectations coming out from the University of Michigan in about an hour or 20 minutes, 7 a.m. Pacific, 10 a.m. Eastern. You did have a drop in the 5-year break even. 5-year break even did drop to a 2.15, which is fantastic news. And if you haven't noticed yet, look at the massive move in the 10-year. The 10-year dropped from over 4%. We were about 4.06 just a couple days ago. And then after we get CPI, the PPI coming in super low, and then Bullard throws in the towel and quits, what ends up happening? Boom. 10-year comes right back down. 3.78. What a crash in those yields. That's actually great. That's going to drive those mortgage rates down again, and it's slowly going to put pressure on that dollar as well. Well, the dollar has been pretty dang resilient. Some folks are actually looking at the dollar as potentially a very good short at this time. The dollar was also great for shorting after last summer, and I was actively shorting the dollar for a period of time. And that's mostly just as we expect interest rates to fall, we expect the desirability of the dollar to be lower. However, there could be a limit to that, given how strong it's been so far. So personally, am I jumping up and down about shorting the dollar more right now? No, mostly because I think there are better opportunities still in actual stocks. So that does it for an intro here with banking and prices. Let's now jump on over to some analysis. Okay, let's see what we have here. We have, I want to get into some of this inflation analysis I've saved up for us. Okay, here we go. There we go. Stand by for some. We need like some music in the meantime, like standby music. You know what you need is you need the walking music from Lost. Did anybody remember watching that Lost? That was such a great show, so awesome. All right, you ready? Now we're going to talk about the bad news from the CPI report, and we're going to be going through a piece from Barclays. Barclays indicates that the June CPI report gave us some good news, but not all of it. And we'll go into some of their argument here, but let's look at a little bit of their preview. In their preview, they're like, wow, Kevin's courses on building your wealth, link down below, are amazing. There's a code expiring in about a week and a half. Oh, it actually says, while core prices eased materially in June, we are reluctant to take too much signal from this, given much of the slowing materialized in volatile categories. Our core CPI year-over-year forecast stands 0.2 percentage points lower at 3.6 in December 2023, reflecting June's downside surprise, and is unchanged at 2.6 for December 2024. Yeah. So, why are they, what do they mean with this potentially volatile sector, and what kind of red flags does this set up for inflation? Let's dive into the report together. Here it is. The June CPI data was softer than we had anticipated, with core inflation easing 28 bips versus to just 0.16 month over month. That's great, by the way. You actually go deep into that 0.2. What did we get? We got a 0.16 that was rounded up. That's fantastic. That's very, very low. However, they say a good chunk of this slowing, particularly on the services side, materialized from an outsized decline in airfares and lodging away from home prices, which together deducted 10 bips from core inflation in June. A decline in used car prices explains the remainder of the deceleration, with June's reading on a 3-month annualized pace for core CPI shifting lower, having previously run or sitting now at 0.3, previously at 0.4. So what are they basically saying here? Well, what they're saying is, look, if we just look at the 13 bip decline that you got from lodging away from home combined with airfares, we've got to consider that these could return with a vengeance in the next CPI report. This is somewhat relative to what we've talked about even before the CPI report came out, where I argued there is a risk that the amount of travel that's happening right now in Europe or really around the world, Asia, Asian travel. So we're looking at people going to Japan, visiting Hong Kong, visiting Macau, coming from the Koreas to America, going from America to Europe. All of this travel is likely to be much greater than the seasonal adjustments expect for July and August. And so I actually agree that I think there are some risks to inflation in the short term. I think we'll end up getting a little bit of a hump and coming through that. It's worth looking at the dates that relates to, and then we'll keep going here with the Barclays piece here. So the dates on the July report, August 10th, right? I would write that on your calendar. So August 10th, we'll get the July CPI report, and then September 13th, you'll be getting the August report. And you can see that on screen here. This is the schedule of releases for CPI. Okay, jumping back over to inflation. Core inflation, oh yeah, here we go. So we view slowing rent. We view slowing in rent and owner's equivalent inflation in June, although only a few basis points lower than May, as a constructive development, consistent with our baseline expectation of a gradual deceleration in housing rents inflation. So that's good. Even though rent has gone up a lot, we are seeing a softening in how much it is continuing to rise, and that's a big anchor for CPI. However, Barclays argues that they don't expect the declines of this magnitude in airfares and hotel costs to repeat, And therefore, they don't think the pace of slowing in services inflation is really sustainable in just the coming months, they're warning here. I think they're right. And I would really pay attention to this as an investor, that if we have some short-term hiccups because of the next two CPI reports, you really have two ways to play it. One, you could sit on the sidelines, but you potentially miss the run up to these reports, especially if earnings are good, right? I mean, you could sell right now and get out before or many company earnings and just avoid the risk of earnings and avoid the risk of those two CPI releases. However, then you also potentially miss the upside. It's likely to be a more, dare I say, transitory hump that we end up going through with the next two CPI reports. There's a very strong argument for just not doing anything. Don't sell, hold on to your positions. If they fall during earnings, buy more. If they fall after those CPI reports, buy more, with the belief that everything will be okay just on the other side. And once we actually start getting into maybe a September read for inflation, which would be October 12th, or an October read. This is, when pretty much everyone's back to school in terms of, students, obviously. October CPI comes out November 14th. Anywho, continuing here. So core goods deflation. Let's take a look at this. Core goods inflation slipped back into deflation, led by used car prices. That's fantastic. Supercore measures of inflation eased materially, but we caution against reading into this too much because of that airfares and hotel costs. While today's CPI data brought good news on the inflation front, we expect the FOMC to look through the fluctuation of these volatile categories to basically continue hiking by another 25 bips. And this is broadly expected at this point. Now, as far as expectations, for CPI going forward, we already saw these, but here's a graphic example of what they expect for year-over-year inflation. And as those base effects become a little less traumatic, remember we just compared from June, the peak of inflation. We just compared. Here, I'll draw that. So June peak right there. That's what we just compared to. And so as these base effects start coming down, it's going to look like we're having less of a drop in inflation. We're making less progress. But that's okay. Remember, even though you've got inflation expected to bottom around September of 2024 by Barclays, you actually don't have J-Pow thinking inflation is going to bottom by really this point. He thinks it's going to take well into 2025. He might end up being right about that. So we got some charts over here, and okay, here's a little bit of dissent. So what do we have over here? We see the potential for core prices to accelerate slightly in July. Honestly, even a slight acceleration, not a big deal at all. And we already covered this. Okay, perfect. Let me get to another piece here on inflation that we have, because I've saved a few pieces on inflation. So this was Barclays, and this was a good one. Here's a Goldman Sachs piece on the recession watch tracker and a turning point for core. So we're going to sort of pit these analysts against each other a little bit. Let's look at wage growth, jolts, and inflation here, just to get a good economic read here. To the extent that these reports actually provide you a good economic read. So here we've got our jobs worker gap based on average jolts and alternative measures of job openings was unchanged at 3.2 million in June. That's how many more people you have who are, or how many more job openings you have versus how many people are actually unemployed, a gap of 3.2 million. That's above the 2 million estimate that they think is necessary for the Fed to feel like the market is likely more in balance. This is down from a peak of 5.7 million of a gap in March of 2022 when the Fed started hiking. Initial claims declined to 248K last month. We've got average hourly earnings growth remained flat at 4.4% on a 1-month annualized basis, and increased to 4.7 on a 3-month annualized basis compared to 4.3 prior. This was that jobs report that we got, right? The jobs report did show a little bit of a tick up in some of those hourly earnings, which is good for workers. It just makes everybody a little bit nervous about, okay, how much is that going to end up feeding through pricing? Core CPI inflation slowed. We know that. However, this was interesting. Web-based measures of new tenant rent growth increased at a 3.1% annual rate in May, suggesting the slower pace of shelter inflation was likely to continue as the gap between rents for new and continuing leases continues to narrow. So this is widely known. We've known that there would be about a 6-month lag in when we actually end up seeing this slower rent growth show up in CPI. And we're just now at the beginning of that showing up, that lag showing up. So it's very good. Market is now pricing in more hikes in the third quarter and fewer cuts in the fourth quarter of 2023. Obvious, most cuts aren't really being priced in until 2024, either March or May for the Fed's U-turn. Let's go a little bit more into detail here. Goldman Sachs actually puts our odds of a recession at 25%. I think I may have mistakenly said 15% earlier. But anyway, 12-month recession odds remain at 25% versus the 65% probability you've got from Bloomberg estimates. So here are the 12-month ahead recession probability charts. And they give you a little bit of a breakdown on how the Bloomberg consensus has changed over time versus Goldman. You can actually see Goldman has had a little bit of a downtrend over here. Let's go ahead and draw. There we go. We'll go with, I'd say you've got a slight, come on. There we go. Slight downtrend over here on Goldman expectations dropping from as high as about 35% to about 25%. And then the Bloomberg consensus has really been bobbing around just over 60% for odds of a recession. Hard data suggests activity growth has rebounded to an above potential pace above the first half of 2023. And that growth does remain positive, but below potential. It's okay. That's kind of what you want. You don't want runaway growth because then the Federal Reserve keeps going down the Bullard path. Okay, we talked about labor market rebalancing. And let me see, I've got a couple more notes in this piece here. Wage growth remaining flat. This just graphically shows you the wage growth via monthly wage surveys and the Indeed wage tracker. I like these tools because they're slightly good leading indicators as well, which help us understand what's to come for future BLS reports. This is why you have a lot of people looking right through the hot BLS jobs report that we got previously here. So nice declines on chart here in wage growth. I want to be clear, that's still a growing wage, still means people are making more money. However, it does mean at a slower pace. Despite that little tick up we had, those leading indicators are looking good. And the bond market, here we go. This is what Goldman is seeing currently priced in for the bond market. Currently, the bond market is pricing in 27 bips of hikes in here the third quarter versus 19 in mid-June. This is basically fully pricing in the next rate hike. Even after these two soft reports, we had a lot of Fed speak talking about, look, we're going to get that other 25 BPs. And so what ends up happening? Of course, the market essentially fully prices it in. This is why we always say, what comes first, the chicken or the egg? Is it the market setting what rates are going to end up doing? Or is it the Fed telling the market what it wants and then the market aligning to that? And then the Fed turning around and saying, well, we're just doing what the market wants. It's kind of entertaining. So let's see here. I would like to also, we'll jump into that in a moment. So the bond market is now pricing in, okay, we talked about that. 1 basis point of cuts are being priced in for Q4, 25 bips of cuts in Q1 2024, 44 bips of cuts in Q2 2024, and almost a full percentage point by the end of 2024 priced in. So market expectations for the Fed funds rate, little change despite these weaker inflation reports. Great, absolutely fantastic. This is all relatively good news on inflation, gives us a nice warning as well, which I think is very reasonable. So we went through Barclays, we went through Goldman Sachs response, and Deutsche Bank did also give us a little bit of an argument on this. Take a look at some of what they have to say about disinflation. They argue here We've had a bullish bias on Euro USD pairs throughout the year, but tactically look to profit in early May. This is their FX piece, where basically they talk about their foreign exchange here, and they're really driven by what's going on with inflation data. So I love looking at the FX pieces because I can glean their inflation ideas on this. And I want to read you what they said. Quick reminder, if you are a course member, you can get a pretty big discount on shadowing me if you're interested. When we go look for real estate, you can come with us, and that can all be done through the Meet Kevin website. We will align how many courses that you've bought, and the more courses you bought, the bigger discount you get. It's really just a huge give back, in my opinion, to the course members. Obviously, there's little cost associated with it, but we think it's a fantastic opportunity for course members, and encourage you to be a course member and then check out shadowing if you'd like. You can always email us at staff@meetkevin.com if you have questions, but otherwise, the website's been pretty great at helping everyone. Today's U.S. inflation print. So this is obviously a piece here from yesterday with PPI and otherwise. But what do we have here? Quote, "We feel increasingly confident that U.S. disinflation is well underway. We have been arguing this is the direction of travel for some weeks now and have highlighted numerous underlying measures of CPI that have quickly been rolling over in recent months. With the latest U.S. CPI print, these are likely to improve further. We would point to the Atlanta Fed sticky CPI metric, which is now annualizing below 2%. They actually provide that chart here. This is the Atlanta Fed sticky core CPI ex shelter. And look at that. It's actually under the 2% Fed goal. The sticky core has basically completely rolled over. This is fantastic, fantastic news. That's great. Okay, so let's see what else we have here. Second, here. Second, the disinflation process looks incredibly benign. We've been arguing that the most bearish outcome for the dollar is a combination of declining U.S. inflation under relatively okay growth. In a world where supply is improving, both of these things can happen at the same time. In this context, the sharp contraction in global manufacturing does not have to be interpreted as a hard landing signal, but as a healthy rebalancing of post-COVID excesses. Now, that is a fire line right there, an absolutely fire line. I really want you to pay attention to that paragraph right there. Honestly, screenshot it because it's so good. I want to explain why it's so good. Every day, I should say every so often, every day I'm basically looking at what are the bears looking at? What are the bears fearful of? And I'll tell you, one of the arguments that keeps coming up beyond the inverted yield curve is, well, just look at PMIs or look at our, those are your PMIs or your purchasers managers index in terms of purchases for wholesale. You can look at your ISM, your Institute for Supply Side Management, manufacturing reports, your S&P manufacturing reports. And when you look at all of these manufacturing reports, you basically have a recession in China for manufacturing and a massive slowdown going on in the United States as well. And so a lot of bears are saying, look, this is bad. The only time this usually happens, these sort of negative reads, is when we have a big recession coming up. But where they could be going wrong is you're comparing to the massive boom of manufacturing that you had in 2021 and 2022. So of course you're going to have some kind of normalization. And that normalization shows up as a negative. It's the same thing as the money supply. Of course, when the money supply stops expanding, guess what happens? The chart goes from an expansion of the money supply to a contraction of the money supply. And therefore, the big percentage chart that people and the bears like to use goes from a big high to a negative. It's not a big deal. It's totally what you would expect the data to do. I think really I'm very confident in this. I'm very confident that we will look back in 7 years, in 2030, and we'll look back and go, well, no, duh, inflation was caused by printing all that money so rapidly. And then we'll go, well, no, duh, it ended up being transitory. That didn't end up forever changing the way our economy functions. Duh, we ended up going back to disinflation and potentially even deflation and rate cuts. Duh, we ended up going back to potentially ZIRP and zero interest rate policy, or NIRP, negative interest rate policy. I know there are a lot of people that tell me, and I get it. A lot of people tell me, "Go, Kevin, you're smoking it again." I don't. But anyway, they say that. They're like, "We're never going back. We're never going back to those levels." I'm like, oh, okay. Talk to me in 2030 then. We'll see. So, okay. Anyway, in all, ongoing, a confirmation that the U.S. disinflation process is underway in a soft landing in the conditions that are most important to the macro for the rest of the year, basically looking good. We highlighted the Bank of Japan as the next biggest dollar risk. The Bank of Japan, you just gotta love them. I still love the Bank of Japan making a joke in Portugal about how, hey, we're trying to build credibility by printing money. Anyway, that gives us a little bit of a breakdown on Deutsche Bank's response. So this gives us really a triple set look into inflation. And really, if the worst is that we might go through a couple months of warmer inflation reads, hotter inflation reads for July and August, then so be it. I don't know if it's enough of a catalyst to say, that's it, get out. It still feels like there's so much, and we're seeing this data-wise too. Fund managers are still underweight equities. Hedge funds are still underweight. You've had some sentiment changes towards positive, bullish, and optimistic, but you're still mostly under allocated to stocks. And that is going to lead to not only a boon to a recovery in stocks, but you'll also see these, what I like to call these rolling short squeezes. I believe that the market just sort of short squeezes slowly over time. But you want to see a massive short squeeze happening right now. Just look at Nikola, for example. Nikola was a $1.20 just like yesterday morning. It closed at 220. Now the thing's squeezing up another 23% here in the pre-market. Now, whether it'll hold is going to be dependent on how the rest of the market moves. We've got Sunbread this morning giving back a little bit of some of yesterday's gains. But point is, with this inflation story going away, it's an easy market to just have everything float up. And you're just going to get these rolling explosions of short squeezes everywhere. It's incredible. So that gives us a little bit of insight on inflation. All right, let's write that down. Okay. Next, we got a piece on the Fed. I'm going to take a sip here, though, and listen to CNBC for a moment.
Is you have to compare apples to apples. And you just realize that all those categories I just gave you, these are substantially in excess of everybody else's. Yep. So you could just say, well, what is this average unit? Whatever is the amount of money they have under management. They may sound
Wells Fargo in their piece, their quick update on the earnings. Goliath is so winning.
Right. That's what it is. And, Carl, one of the things that's so hard about today is you'll have all the major banks reporting, and they're really difficult because there's a lot of lines, like the return on common equity, that people say, well, what the heck is that? I just want people to realize, let's just say these were semiconductors. This is NVIDIA. It's just faster than anybody else.
Well, we're not getting guidance changes like that, but
yeah. No, but I want to say that there's NVIDIA and then there's everybody else.
Right.
I have to say that when I look at JP Morgan, there's JP Morgan, and then there's everybody else.
Charge-offs, obviously, we were going to look for it going in, up 34 basis points quarter on quarter. 2.4 is still better than we were this quarter in 19.
Right.
3.25.
Right. But, look, I think this First Republic's already a winner. Net interest income, $21.98 billion. I know it's only at 5 versus Wells. Wells had a better number than NII.
On net interest income,
yeah,
Wells
did.
Was better.
Yeah, Wells was definitely better
in terms of the increase.
Yeah, much, much better. But I just think that you take a look at this and you say, all right, let's say you didn't have intense regulation of the banks. And let's say you had banking like you do have in the United Kingdom. Like JP Morgan, that'd be one of 4 banks, and they would be the big bank. This is, if you go back to 1906 to 1932. JP Morgan. And then everybody else, here we are back in that period. And what did they call JP Morgan? Which is now
All right. Well, we're going to pull back here on a Jimbo here for a moment. It's just a little bit of rambling, but I need to do my own little bit of rambling, and I'm going to do that about crypto quickly. So let's talk about Ripple. So we're going to talk Ripple. Let's do that. Okay. All right. Yesterday has been heralded as a massive day for the crypto community, as essentially social media and everywhere is a buzz over the idea that Ripple was not ruled a security by a judge overseeing the case of Ripple versus the SEC. And this has been great news for the crypto community. We saw a lot of coins immediately jump on the news, tokens jump on the news. We saw excitement across the board for the crypto community, specifically because most individuals and most of the exchanges that we see do not want to hear crypto, Bitcoin, Ethereum, or any token or coin or anything to fall under the purview of the SEC's jurisdiction. Now, generally, the test for whether or not something is a security is whether or not there is a reasonable expectation of any kind of participation of profits in investing in whatever you're exchanging. And so, for example, if you invest into Tesla stock, you expect some reasonable either capital appreciation for the value of your stock going up because the company's performing better, or you're expecting some form of dividends in the form of earnings distributions, right? So in this case, as Cameron Winklevoss put out here on Twitter, the sale of XRP on exchanges is not a security, which means the sale of all cryptos on exchanges are not securities. And the SEC and Gary Gensler have no jurisdiction over them. This is a watershed moment that regulates the SEC, or relegates, the SEC to traditional finance and makes it a dinosaur regulator. Bye-bye. All right. Obviously, the Winklevoss twins and Gemini are going to have a very, very pro-crypto approach here. And let's take a look at just the segment of the ruling that they highlighted, and let's analyze if we think Cameron Winklevoss is actually as aggressively correct, and is the crypto community 100% right in how we're looking at this ruling. Don't get me wrong. Still, and either way you slice it, this is a win for the crypto community. But let's go a little bit deeper on this. So, having considered the economic reality of programmatic sales, the court concludes that the undisputed record does not establish the third Howey prong. The third Howey prong is a reference to the Howey test for is something a security. Here, we get an explanation of that prong. Whereas the institutional buyers reasonably expected that Ripple would use the capital it received from its sales to improve the XRP system and thereby increase the price of XRP. Programmatic buyers could not reasonably expect the same. Indeed, Ripple's programmatic sales were blind bid-ask transactions, and programmatic buyers could not have known that their payments of money went into Ripple or any other seller of XRP. Therefore, the vast majority of individuals who purchased XRP from digital asset exchanges did not invest their money into Ripple at all. An institutional buyer who purchased XRP directly from Ripple was different, but the economic reality is that a programmatic buyer stood in the same shoes as a secondary market purchaser who did not know to whom or what it was paying its money. Okay, let me translate this to English so we can understand this. And I'm going to tell you where there's a problem, because there is a problem here. I'm going to talk about that. Quick reminder, if you like my perspectives, make sure to check out the programs on Building Your Wealth. We got a real estate investing course that's amazing, 0 to Millionaire Real Estate Investing. Everybody should be in that course. Stocks and Psychology of Money, fantastic course on stocks. We do fundamental analysis every single day, teach you everything we know about stocks. It's not just me, it's the entire team as well. It's great. And then also check out the do-it-yourself property management, check out the sales courses. And a big one that we just released is how to make more money and get SH9T done faster featuring AI, which is a really good way to improve your income if you're an employee or an entrepreneur. It really appeals to everyone who's a worker. How can you be more efficient? How can you make more money? And ultimately, how can you thereby build more wealth? So check out those links down below. We've got a coupon expiration in about a week and a half. So what is this in English? So in English, this is basically saying, look, people who just bought XRP on the exchange were basically clueless people who had no idea that their purchasing of this of XRP would actually benefit the company. And since they didn't know, them adding buying pressure to XRP would benefit the company because, they're just buying it on an exchange, then obviously it can't be a security. Okay, let's pull that back for a moment. There's almost no difference between buying XRP from digital asset exchanges here and buying a stock through a broker on the New York Stock Exchange. I see virtually no difference in that. So I think this is a very weak argument that the judge made here. It's obviously fantastic for the crypto community, but I would be concerned that a future judge or appeals court is going to nail this and go, wait a minute, how could you say stocks basically that trade every single day in the stock market and trade through an exchange or a security, but then something that trades through an exchange just because it trades through an exchange the XRP sales is not a security? That I don't know is the best argument the judge is making. The judge says, hey, well, people didn't know that they're adding buying pressure to XRP increased the potential value of those coins, which made Ripple essentially have the potential for more funding and therefore an improvement of the actual Ripple company and ultimately the return of potential capital appreciation to XRP. I think that's a very bizarre argument to argue, oh, well, people, they were just buying on exchanges. They had no idea so that it would benefit Ripple. They didn't know. Of course they did. Come on, man. Everybody, when you buy a token or a coin, you're investing in it, not because you want the coin or token. It's because you want capital appreciation. Duh. So I think this, while it's a fantastic ruling for crypto, I think it is a very, very weak ruling. So again, it is fantastic. I want to be very clear about that. It is good for crypto. Going in the right direction here, but it's very weak. When I read this, I was on the plane, and to me, I found this bizarre. We'll go through a little more of this, but initially, my first reaction to this was, okay, this is weak. It's probably going to get ripped apart in the future. But let's go get the full ruling here. I want to get the full ruling so we can get through a little bit more than just what Winklevoss mentioned here. So we're going to pull this whole thing up. Give me 1 second here. I'm going to take a moment. I had it, but I accidentally closed it. Okay, here we go. I got it. Just give me another 20 seconds or so here. There it is. Put it in my good notes. All right, here we go. Importing. All right, here we go. And going to Mr. Winklevoss. All right. Stand by. Almost there. Okay, here it is. Okay, so this is the full ruling without the Winklevoss highlighting right on the page where we were. So now take a look at this. This is where we keep going, and the judge actually does somewhat address the speculation argument, which I thought was useful as well. And this is their argument. They say, Further, it is not enough for the SEC to argue that Ripple explicitly targeted speculators or that Ripple understood that people were speculating on XRP as an investment. This is because, basically on the part of the purchaser or the seller, does not evidence the existence of an investment contract. And they give this example here. Anyone who buys or sells a horse or an automobile hopes to realize a profitable investment, but the expected return is not contingent upon the continuing efforts of another. Now, that's actually really important for the Howey test, because when you invest in Tesla stock, you're expecting a return based on the actual fundamental business improving. Now, generally, when we're looking at tokens, let's say on the Ethereum network, we're looking for utility, right? So there could be an argument made that, hey, with utility tokens, or maybe not, we shouldn't call them utility tokens, but thinking like non-exchange tokens, right? So you've got oh my gosh, Voyager's token was really just obviously now we know potentially a Ponzi, especially after what we saw with Celsius yesterday, which was so sad because the CEOs basically of these companies were lying straight to our faces about these. But when we look at Ripple and XRP, I think another judge in the future could make a pretty decent argument that no, the people are buying XRP with the expectation of the underlying system improving, and therefore there being an expectation of profit from this, and maybe it is a security. It's going to be really interesting. So again, for me, I didn't think it was the strongest argument. It is in the right direction, but I look at it as somewhat weak. So I wanted to just add sort of my 2 cents to that. Let me see. There was a little bit more I wanted to look at here as well. Look here, they to address it here as well. Programmatic buyers may have purchased XRP with the expectation of profits to be derived from Ripple's efforts. However, the inquiry is an objective one, focusing on promises and offers made to investors. It is not a search for the precise motivation of each individual participant. This is another example, in my opinion, of a weak argument. It's a very good argument for crypto, but again, weak, because what does it do? It tells you, look, here's a judge now saying, well, we don't think this is a security because even though some people might want to profit off of the network improving, we're actually not thinking that Ripple advertised this as potentially being, a promise of making money, basically, or there being some sort of promise of making money. Again, I think I made my position pretty clear on this one. Not jumping up and down about it for a long-term point of view, because I think they're going to hit this one. But we'll keep an eye on this one. Okay, so let's go into, I want to hit this other piece from Nick T that we saw and go into this a little bit. Okay, so let's see. Car for Coin, I see your comment here on the initial coin offering is the one that had the expectation of profit, not the second party sales. I mean, I disagree with that. Every stock you buy in the stock market is a secondary transaction. It's not, you're not transacting with the company itself. You're exchanging it with somebody else, right? So the expectation of profit from the first buyer is really the same as the second buyer. And creating that separation, when you compare it to stocks, again, it just seems loose. Okay, so let's see here. Again, don't get me wrong. Like I said, it's great for crypto. I just think it's weak. That's it. That's my opinion. I guess I could just shorten it to that. All right, so let's see here. Let's get into this Fed piece. Okay, 49. All right, here we go. Well, Nick T is back at it again with releasing another Wall Street Journal piece. And boy, he basically nailed what I've been thinking, that this guy's got all the leaks. And the reason I say that is because you could not make it up. Within 7 minutes before the CPI release, he tweets out and says, hey, just in case CPI comes in lower than expected, be careful the Fed might still hike, and they're probably still going to hike. They'll end up looking through this. And I thought it was so funny because sure enough, and I remember saying it as we're covering the CPI report. I remember saying, oh my gosh, Nick T just tweeted that inflation's, if inflation comes in low, don't get too excited. Basically, don't let the stock market moon. And we joked that he probably got a message from Jerome Powell that was like, hey, man, can you please temper the economy in the event, or markets in the event inflation comes in low? Nudge, nudge, wink, wink. And then happens to right before CPI comes out. It was brilliant. Sure enough, it comes in low. So Nick T has a very interesting perspective that I always like paying attention to, because mostly I think he gets those text messages from good old J-Pow. So what do we have in the latest Nick T piece? Well, that's right here. The outcome of the Federal Reserve's July meeting appears to be all but decided. Many officials signaled in recent speeches and interviews that they support a 0.25 percentage point increase that lifts interest rates to a 22-year high. Okay, big deal. So you get another 25 bips. Nobody really cares about another 25 bips. Every time I say that, I get people who leave comments who are like, oh my gosh, but wait a minute, Kevin. People do care about another 25. The Fed's gone too far. I go, no. Nobody cares. Or you shouldn't care. Another 25, it's not a big deal. What you should care about is how quickly we went from 0 to 500 basis points, not another 25. Anyway, the real debate, though, is going to center on what it will take to prompt another rate hike in September or in the fall, and what kind of guidance the Fed gives. Because remember, it's not only the next meeting, but it's also the next summary of economic projections. The next summary of economic projections comes out in the September meeting, and that's where they're probably going to have to start forecasting some lower or some more guidance on lower rates in the future, and that'll likely be seen as quite bullish. But let's see what else Nick T here says. The Fed last month held benchmark rates steady. This was the pause. Most officials anticipated 2 more rate hikes this year would be warranted if the economy grew modestly and inflation pressures eased steadily. Despite the better news on inflation released Wednesday, officials are motivated to lift rates this month in part because overall hiring and economic activity since May have been stronger than anticipated. In addition, some officials want to see that inflation continues to ease before ending increases. It's really a way of saying, look, and this is my take, I really think this is a way of massaging expectations. That they want to tell you, look, we're going to keep strong at this. We're going to keep hiking until inflation's down. And that does lead some bears to say, okay, look, we're going to end up seeing the Fed at this for a while because they're not going to stop until they get to 2%. Yeah, they will. They will stop way before they get to 2%. They will stop substantially before that. But again, a lot of the bears use that as ammunition to say, see, look, we're so far away from 2%. But even Jerome Powell himself says, hey, the calculus is very simple. We will lower rates when our formula tells us to. And what's the formula? Well, it's inflation expectations plus some level of restrictive levels equals the FOMC rate. So if some level of restrictiveness is, say, 2.25%, and inflation expectations are 3%, then you get a combined 5.25% rate. Inflation expectations come down 1%. Now you're at 2%. Rates come down a full 1%. You're about 4.25. Let's keep going with the Nick T piece here. Despite the better news on inflation, okay, we read that one. So they're basically blaming hiring here still being strong. I would say we're close, but still have a little bit of work to do. This is Michael Barr. That's the vice chair. You've got a Waller saying in a speech Thursday evening in New York that he wants to see evidence that the latest inflation slowdown wasn't a fluke. A recent report warmed my heart, but I've got to make policy with my head, and I can't do that on one data point. You know, I think it's hilarious that they keep talking about one data point when we've literally had, 6 months now of declining inflation? Actually, probably more. It's actually probably, you could just go back to last June peak. I mean, basically since then, inflation peaked out. You did have inflation that was a little bit more volatile in the core segments, but otherwise, really the last year has just been a disinflationary story. J-Powell framed last month's decision to hold rates as an effort to give officials more time. Even though several officials wanted to raise last month, Powell secured unanimous support from the rate-setting FOMC committee, in part because officials strongly signaled more raises were likely. No kidding, more rises. This was really where we were thinking Jerome Powell made a deal with the Hawks. And the deal was, look, we'll give us the pause here, but we'll make sure to promise everyone another hike is coming. It's exactly what Jay Powell ended up doing. Quote, I remain very concerned about whether inflation will return to target in a sustainable and timely manner, says Lori Logan. She's a voting member. What I think is so interesting about this is the timely manner part. Jay Powell's already told us is between now and 2025. It's not this insane rush. Anyway, interest rate increases slow the economy through financial markets by lowering asset prices, raising the cost of borrowing. Yeah, well, the whole lowering asset prices part, that hasn't really been happening. People are doing pretty dang A-okay here in terms of asset prices rebounding, whether it's rebounding from the real estate lows that we saw by December, or it's the stock market lows that we also saw in about December. Kind of an interesting alignment if you think about it. You had basically a double bottom for both of those in December. Okay, let's see what else we have here. There we go. And one sec. There we go. Okay, so Logan said she voted in support of last month's pause, even though she favored an increase because officials delivered an overall package of communications, strongly signaling more rises were needed. See, it just goes to show you, it's like, hey, go tell the market this, and then we can agree to do so. It's all about this communication. Hawks could argue that at this month's meeting that the Fed should be prepared to raise again in September. That would be the 2 hikes. I've heard from my business contacts in my district that if you think you're going to have to move rates up, just get it done, says Loretta Mester. That's true. That's because there's so much uncertainty created around this idea of like, oh, are they going to hike or not? I think people just get to the level and be done with it. It's a very Bullardian argument, although he was interested in getting to anywhere between 6 to 7%. It's remarkably high. Waller said Thursday that if inflation doesn't continue to decline and there aren't signs of a significant slowdown in the economy, then he would favor a second hike in September. The data looks like we're making progress, and consumer prices for July and August resemble the June reading. The data would suggest maybe stopping. Well, we'll see, because again, July and August CPI data we think might be a little warm. 2 officials last month thought the Fed wouldn't need to raise rates again. Bostic, he's always in, let's wait and see. Let's let the policy work. Yeah, again, another 25 here or there. It doesn't really matter. We've all seen inflation be over and over again more persistent and stronger than expected. Powell said at a conference in June. It's true. Well, the other thing, too, is you got to look at the United Kingdom and Germany, where you've seen a little bit of a reacceleration in some of the core numbers. And that is something that is going to concern us at the, here in America, but also the Fed, because if we get any of those kind of pushes up, we have a little bit of a problem. And now all of a sudden the market has to potentially continue to price in hikes. Then we start getting to 5.75 and maybe even 6% before the cycle is done. If you get a reanimation just over the next few months, that's why I think there is going to be that potential for volatility over the next few. So we'll watch that very closely. So anyway, this gives us a little bit of an insight into Nick T's latest commentary on the Fed. So that does it for the Meet Kevin report today. We will be back. Thank you so much. Have a wonderful day. Good luck. Hopefully your trades or your long-term buy and holds do well. I'm going to jump over to the course member live stream now. We'll do some analysis together and answer some Q&A. Do that all together, so make sure you come join. Link has been posted for the course member stream, and we'll see you there.